Hey everyone, and welcome back to the show. Today, I'm so excited to announce our special guest today, Brittany Mithra, who is a graduate of the same MBA school that I went to, which is the David Tepper School of Business. So, Brittany, welcome to the show. Thanks so much for being here. And then you say,
Thanks. It's great to be here.
Awesome. So everyone, Brittany is an MBA grad that has been working for Amazon in their retail business for the past 8 years, looking for investment opportunities to increase her passive income. Awesome. Well, that's really exciting. I know you've got some stuff under your belt, which we'll get to. But for now, Brittany, why don't you tell us what was it that inspired you to start increasing your passive income? I mean, both you and your husband earn, relatively high, you're at big companies earning high salaries. Why are you looking to increase your passive income?
Yeah, I think we're both really interested in becoming, financially stable and looking towards retirement and a possible way to get there faster and through passive income so that we can have that stability and look forward to retirement.
Awesome. And just curious, have you thought about when you might like to retire? Like, would it be in your 40s or 50s? Is that part of your plan yet?
Yes, I think probably sooner rather than later, looking in the next, 5 to 10 years at least, but really looking in our 40s.
Awesome. I love it. Well, that's really great to hear. And I want to talk about what you've started with, because I know you have some investment properties already. So what was the first sort of step that you took when you decided you want to take action and look at investment opportunities outside of obviously your 401ks and other retirement accounts?
Yeah. I actually bought my own home prior to getting my MBA. So I lived and owned a home in Memphis prior to going back to school. And at the time, I just looked to rent it out versus selling so that I would keep that property. I had bought in 2007, so the first kind of financial crisis, and wanted to hang on to the property just to increase the value of it before I sold, and so wanted to keep it. Found renters. I was able to rent for the 2 years that I was in school, and have been able to keep renters in the property since. And so I've had someone in that property for the last 10 years. And that's really the only property that I have and own and manage. And then my husband does have a property that he manages with a friend, and they just bought it just for rental income. More as just kind of like just something to play around with and test. But since I think he's got some friends that have really done a lot more rental properties, and we're just looking to get started.
Yeah, totally. And so curious, you can speak in general terms, but have you been happy? Will you speak to the returns that you've been getting from those investment properties?
Yeah, I think for a long time, I made a lot of mistakes on at least the one that I've been managing, which was a home that I was living in. One, I had a really high interest rate to begin with. And so I was paying so much in interest through that. I didn't refinance before I went to school. And so I was stuck with that, could not refinance while I didn't have a job. And so that kind of delayed that process. And then since have really tried to, I think I went down the path of like paying it off really fast, signed a 15-year loan and just to make even. So like I wasn't actually getting income from it. I was just kind of netting out even with the rent that I was getting. And then this past year, I have refinanced again to the point where like I signed a 30-year loan and actually am able to get passive income from that property now. So it's been, 9 to 10 years coming, and just now kind of getting to where I'm getting passive income.
Awesome. Well, I mean, we all go through a process as we learn to invest in real estate. And I assume the property has probably appreciated a fair bit over the last 15 years or so. Is that, would you say so?
It has. I don't know too much, but at least 20%.
Okay, cool. Yeah. And have you considered, well, you've refinanced, so you've done a cash out refi then, or?
Yeah.
Okay,
yes.
Cool. Well, so great. So you have some experience as a landlord, and we talked a little bit about the income side. What about the management side? How has it been managing that property?
It's been up and down. It depends on the renters that I have in the property. I've had some that have been wonderful and great, and I've had some that are not as easy. Across the board, people that are really high maintenance, or things, break a lot. It's often inconvenient for me. I have done it myself. I haven't actually used a management company yet, but I've had calls on like Christmas Eve saying that the roof was leaking. So just really inconvenient times, but have just kind of dealt with everything ad hoc.
For sure. And how excited are you to buy more rental properties at this point?
Not really. I don't think it's something that I'm willing to take on. I think I want something that is as low maintenance as possible, especially while working. So having a full-time job, and then also having something that just like pulls you away, and something that's unpredictable is just not something I'm looking for right now. Like maybe in retirement, I would feel more comfortable managing myself, but not something that I'm looking to do right now.
Yeah, it's such a good point. I mean, I remember working full-time and managing rental properties, and it was, even if you have a property manager, but if you don't, then, screening tenants is, even just that you have to schedule it outside of work hours, which is really limiting. And that makes it so that you can't necessarily screen everybody, just for example, and it's unpredictable. You don't know when it's going to happen, right? So in addition to the litany of other things that may happen with rental properties. So that makes sense. So what else have you been thinking about as far as passive investments, and when did you get introduced to syndications?
Yeah, I've also been looking at in investing in stocks that pay dividends. That was kind of my first introduction to like thinking about how do I create that passive income and setting myself up for retirement to be able to do it through that. However, it's difficult to find that right balance of stocks that you're willing to buy that also pay good dividends, and it's really unsure and unstable sometimes. And so I first found out about syndications through you reaching out. So appreciate that.
Okay, awesome. Yeah, well, that's really cool. And, we've already talked about it, but we're going to kind of redo that conversation that we had where we started talking about real estate syndications and what they are. So we'll just do a lab right now. So shall we get started on that part?
Yes, please.
Okay, awesome. So, Brittany, do you know what a real estate syndication is at its core?
No.
Okay, so essentially a real estate syndication is a group investment. And, one way that I like to talk about it is explaining, like, if you were going to buy a rental property and then you bought one and then you're like, hey, I like this, I want another one. And then maybe this time you're like, but I want to get a little bit more income, so I'll buy a duplex. And then you still like it. And so you're like, okay, I want to buy a fourplex. And then you kind of have been developing your skills as a landlord. At some point, though, you basically don't have any more cash, but you actually want to buy like a 10-plex next and you can't buy it. It's available, you can't buy it. And so maybe you invite your friends and your family along to participate alongside you and say, hey, what if I operate the project? I'll be the landlord. You guys put in money and I'll get some more of the upside. I'll get some more ownership in the property in exchange for me managing the property. And this is what I think how well I think we can do with the property. Would that interest you? And so that's kind of like a core example of what a syndication is. Usually, does that make sense?
Yes. Thank you.
Okay. So usually we're in, these days we're doing, sometimes syndications can be larger, but they can also be as simple as that. And so basically one of the benefits of syndications is that you get to own real estate. Like, you get to expand, you and your husband own like, 1 or 2 rental properties. You get to expand your real estate portfolio without actually having to scale your responsibilities. So does that sound like interesting and appealing to you?
Yes, very much so.
Yeah, I mean, I think it probably appeals to all of us who've been on the landlord side at some point, especially because these are things you might not be aware of, but are you, like, for example, are you aware of the tax benefits associated with real estate?
Just on like the homeowner side of just like how you pay it off. I don't do my own taxes. So I tend to just like send all of the info in. So could you walk me through some of those, some of the benefits that you really see?
Yeah, for sure. So, I mean, investing in real estate, one of the main reasons people invest in real estate is just for the tax benefits. And that's because real estate has benefits from a lot of different tax advantages. So for example, we get to depreciate the property. And, under normal circumstances, residential real estate can be depreciated over 27 years. So if you had $1 million property, that's about $30,000 a year that can be depreciated, which means it's counted as a loss. I mean, that's as long as the building's worth $1 million, not the land. And so, whatever your rental income is, like, let's say your rental income is $50,000 after expenses, just as an example, then you can actually count $30,000 against that from depreciation. It's just purely a paper loss. So literally you're just dividing the value of the entire building by 27.5 and then depreciating it, which is counting it against your income. So we also get to take bonus depreciation and cost segregation for different things. The tax advantages have only gotten better in recent years. And so, so we'll get into some more about the taxes in a minute, but for now you get to own real estate, which means that you are a direct owner, which means that you get the tax benefits. You don't have any responsibilities, and the returns are often very comparable to what you would see, or even better than what you would see. And that's because the sponsor is really an expert at their particular asset class and their particular strategy. Now, of course, we're going to talk about the sponsor soon, but assuming you have a good sponsor, they have an expertise in managing, say, self-storage or multifamily or senior living or something of that nature. And they're really good at looking for the assets that are ones that they want to buy and figuring out a business plan and then executing the business plan. They're also good at negotiating. They have relationships with brokers. They know how to close. They have relationships with lenders, which is necessary in order to close quickly. And once you develop a reputation, it's easier and easier to get deals. And so basically they are able to execute a strategy and close on deals with expertise. And for those of you who've been first-time landlords, which I definitely have been, it seems like it might be sort of simple, but then I don't know if you can relate to this, but for me personally, once I became a landlord, I was like, oh my God, there's like so much stuff that I don't really know how to do and so many decisions that I have to make. And it's just like a whole nother thing I have to learn. You know what I mean?
Yes, absolutely. When you say sponsor, is that, do they also do the property management for you, or is that someone different?
That's a great question. So the sponsor is usually, the deal sponsor is the one who's in charge of the deal performance. They are sometimes vertically integrated, meaning sometimes they do have property management as part of the company, but sometimes they don't. And sometimes they hire a property manager and they manage the property manager. And that's called asset management. And so property managers are a really key player. You want a really good property manager, but the sponsor is not always serving as the property manager. When it comes to asset management, that means that they're basically directing the property manager and making sure that things are going the way that they want, and handling problems as they come up, but they're really directing. So yeah. Does that make sense?
Yes, thank you.
So basically, like, the returns can be often similar, if not more attractive, and you don't have any of the headaches. You also don't have extra liability. So you're not necessarily you don't have nearly the same amount of liability as a limited partner when you're passively investing in deals than if you actually own a house. Like, if someone, were to slip and fall at your rental property, then, in theory, you could be sued for that. And so you don't have that liability also when you are a limited partner. Only your principal is at stake, which is actually, most people don't realize how much liability there is when you own real estate. So the sponsors take that on, and they also are somehow guaranteeing the loan either through a guarantor or with their own balance sheet. Like, oftentimes sponsors are personally guaranteeing the loans. And as a limited partner or a passive investor, you don't have to do that, right? You don't have to personally guarantee the loan on the property. So that's another major advantage. So those are some of the main benefits. And what comes to mind as far as a question that you have right now?
What specifically are kind of the expected returns on this, and then how does that compare to not just other I guess rental properties, but if I were to invest in like stocks or funds, what does that look like in comparison?
Yeah, for sure. I mean, that's a great question, and that's oftentimes what people think about when they're first thinking about, these deals. And I mean, the first thing that I would say is that, and not to what most people say. And the truth is that while it's it's important to kind of know where it's going, it's also not the most important thing. Like, the most important thing that you want to know is that you can trust whoever it is that you're investing with, and that you can trust them to do the best by their job as possible, and that they have the experience and the track record necessary to actually steward your capital effectively and efficiently. So that's the most important thing. The returns are still important, and I don't get me wrong, I love talking about returns. So every deal is different for sure, and the market kind of evolves over time. So there was a period, for example, between like 2014 and 2018-19 where you could get extremely high returns on these deals, and the market has since changed a little bit because everyone was expecting a correction, and then it's just like there's an anticipated, like, we can't sustain this level of returns. So what we're currently seeing somewhere around the mid-teens for projected returns. So somewhere between, I feel like as far as average annual return, I've seen anywhere between 12 and 18% recently. That also, there's different structures, there's different deal structures that can kind of change what that projected return is. So that's average annual return, which is, that's the total of the cash flows plus the appreciation from sales. So there's two places you get returns in real estate syndications. One is through cash flow. So we're collecting rents and we're trying to increase the rents and improve the property. And so we're increasing rents and able to distribute cash flow during the hold period. And then we're also selling the property we're increasing the value. And we can talk about that if you want, about how we actually increase the value, and we sell for a profit. And so that's called appreciation. And so we get appreciation at sale and then cash flow. In between those two, you add them all up over the course of, say, 5 years is a typical hold period. So you add up the cash flow year 1, 2, 3, 4, 5, and then the appreciation, and then divide that by 5. And that's how you get the annualized return.
How often do you, when you're thinking about buying a property, do you look at that sale versus just like you said, you're looking at it at 5 years, but do you actually expect to sell it every 5 years, or after 5 years after purchase, or do you hold on to it for longer?
Yeah, that's a great question. And different sponsors have different preferences for what they like to do. So, for example, there's one type of sponsor which prefers to sell. And so they, obviously year 5 is not necessarily when the property is going to sell. They could sell in year 3, 4, 5, or they could, be forced to sell in year 6 if necessary. But usually sponsors want to exit before year 5 if they can. And then the part of the reason for that is because we're incentivized, or the tax code favors buying new real estate currently. And so you can capture more depreciation if you buy and then sell a new property. But there's plenty of investors who also are buy and hold investors, and they want to just build a large portfolio, and they want to own buildings that they really like, properties that they really like into perpetuity. And so what happens in those situations is they will sometimes be able to refinance and pull cash out and return investor capital. And sometimes some sponsors will buy the investors out at that time. Other sponsors will just keep the investors in the deal and put cash flow off to the investors for basically until whenever they want to sell it or whenever they want to get bought out. And so that's called infinite returns, because you've gotten all your money out. So you put $50,000 in, you've gotten $50,000 back. Now you're still receiving 10, 11, 12%, let's just say, in cash flow every year. And so that's called infinite returns.
Interesting. How would you recommend seeking out a sponsor that is looking for your style? So what if you wanted to buy and hold, or are more interested in kind of that infinite return model? How do you seek out sponsors that do that versus sponsors that are really looking to sell?
Yeah, for sure. Well, and the thing to keep in mind is that it's not necessarily preferable to get infinite returns. I mean, it's kind of nice, but when you sell, you're also getting a ton of equity. You're getting a ton back at the same time. And then, so say you get the returns are often similar, over a long period of time, it can be similar. And the other thing is that you can take the sale proceeds and immediately put it into another deal and maybe potentially do even better, because you're still able to get tax advantages. Yeah. But if you are looking for that specific thing, and it's something you might feel out over time and decide, well, do I want infinite returns, or do I want to be continuously turning my money over? Because the thing is that if you're getting infinite returns, then you're also paying taxes on that income every year. So if you might be getting 12%, but then you have to pay 30% income tax on it, you don't have a way to offset that with losses, then maybe you want to try something else. And so that's another thing that we that's cool about when you buy real estate. So if you buy a syndication, for example, one building I bought, I didn't buy this, I put money into a syndication as a passive investor. In December, I put $50,000 in of 1 year. And then the following March, so just a few months later, I got my K1, and it was for negative $20,000, negative 21,000. So basically that means I had negative $21,000 just from making an investment in December of that year that I could count against other rental income, or I could count it against if there had been another property that had sold that year and I had capital gains, I could count it against that. So there are benefits to turning properties as well. You just kind of got to figure out what works for your unique situation. But basically, networking is really the best way to look for different sponsors. You know, I personally work with sponsors who do both. You know, I have some sponsors that I work with that are, you know, going to buy and hold. And then I have other ones that are going to turn and sell their property. And a lot of people, you know, want to have that. They want to capture all of the value all at once because of various reasons. They want the liquidity, for example. Does that make sense?
Yeah, that's helpful. Thanks. You mentioned a little bit about just how to kind of like offset your taxes, and how can you walk through like how does that work when, or how do you know when you should kind of invest in enhancements or improvements in a property, and how does that work through syndication? I know how that works like as a single homeowner, but how would it work through like a syndication and in making those improvements?
Okay, yeah. So wait, there was the improvements question, and was there something else before that?
And how to just walk through like how that works with taxes.
Oh, with taxes. Okay, so we'll hit the taxes first. So with taxes, you know, and I'm not a CPA and everyone needs to talk to their accountant, but this is just general information, disclaimer. But basically with taxes, you don't actually have to do anything to take advantage of the tax benefits, because all you're going to do is you're going to receive a K-1 every single year, and then you're going to pass that on to your accountant. And so they're basically going to receive the K-1, and it'll basically say that at least in the beginning, you probably, for most of the whole period, you probably won't have to pay much or any taxes on the cash flow. And then at the end, there will be some capital gains in the year of sale. There will be some capital gains and depreciation recapture. And so in that year, you'd want to have like a strategy for what you're going to do. Like, are you going to, you know, make another investment and so passive losses can only be counted against passive income. So the passive losses from your real estate syndications cannot be counted against your W-2 income. But it's better than stocks. Like with stocks, there's no depreciation. And so you can't take advantage of any of those paper losses, even with a REIT. Like, so with our real estate investment trust, that's not direct ownership in a property. And so you don't get the tax benefits when you invest in REITs. So that's taxes. Okay, so now improvements. So the sponsor basically decides what improvements to do and when, and they often raise capital as part of or they're able to take a loan out for improvements from the bank. And so the sponsor will actually receive or they'll have a construction plan and a budget, and they'll have an idea of how much they want to spend per unit. Like, do they want to spend $5,000 per unit, or do they want to spend, you know, more or less per unit? Do they want to upgrade the common areas? And so they'll have a renovation budget, and then they either raise capital for that or they get that in the form of a loan from the bank. And so that they execute the business plan. And sometimes it's a bit of a scientific process. Like right now, there's probably a lot of testing that's happening. Like, will people pay for, you know, updated cabinets, or will they not? And so I know sponsors that do A/B testing to decide whether or not, you know, they're going to, because like, for example, we're in a pandemic right now still, and while we're coming out of it, people in some markets are still wanting to buy what we call, you know, the classic units. So not the updated units. And so when we're deciding, like, are we going to be updating all of the units, we'll just say, okay, so with this unit, we're going to, you know, it's kind of like a controlled experiment where you maybe do everything except the floors. And so redoing the floors, does that get you a premium on rent right now or not? And if it doesn't get you a premium on rent right now, because we're in a pandemic, then maybe we'll wait until the market continues to shift before redoing more of the floors. Does that make sense?
Yeah, that does.
So basically just trusting the sponsor to, you know, to make those decisions and execute on them.
Right. Does that work the same way for things that like break? Do they just kind of create a budget for, like, if you need to replace a hot water heater or replace an air conditioning unit.
Yes. So not all sponsors are created equal. And so it is something that, as you get to know sponsors, you'll understand what it is that you want to see in their numbers. And what's typically sponsors should be doing is including what we call a CapEx, capital expenditures line item in their budget. And that means, say it's like $250 a unit or something, and it's like a 100-unit property. So every month they should be putting $250 per unit away in basically repairs, like a capital expense account. And so that is how, so say like, for example, that basically means that they're going to be having a slush fund of sorts that they can use for replacing appliances, replacing even like, repainting the exterior, repainting the roof. And so there's like ways to calculate what a conservative CapEx budget should be. It's usually more if the property is older, what the industry standards would be. And it's usually less if the property is newer, because it just isn't going to need as many repairs. So that's how we handle that. That's sort of separate from the upgrades. That's more of like an ongoing expense that we just budget for. And does that make sense? It's kind of similar to, I think, what like HOAs do, where they, have you put away money, and then the HOA is responsible for like the roof, for example.
Yeah. What, I guess for someone that has never invested through syndication in kind of commercial real estate, what do you recommend for getting started? Is there a place to like get that's like better for newcomers, that's like less risky, or how do you make those decisions?
Yeah, totally. Well, I mean, I think when you're choosing a sponsor, in general, it's really good to get to do some networking and to get to know people, because you always want to have a positive gut check with whoever you're working with. You also want to ask them for investor references. One thing you might do is ask them for previous reports that they've provided to their investors, so you know what their reporting looks like. Because if you kind of want to know, well, how often are they going to be checking in with me? What are they going to be sharing with me? And that can be nice to know. And then another thing is making sure that the deal is structured such that your interests are aligned with their interests. And so when do they get paid? Are they getting large fees up front? Are they taking an asset management fee? And what is the waterfall split look like? And so, that's a slightly more advanced question, but it is something that you'll want to become familiar with as you start doing more of these deals. Is you want to make sure that the deal is structured such that basically nobody gets rich too fast, so that as the deal sponsor, we're getting paid when the investors do well. And that's like, I mean, and there's some nuances that we can explore some other time, but that's the basic idea. Yeah, so I mean, networking is a really great way. And there are a lot of like listening to podcasts like these. You can get to know folks by listening. You'll hear their voice, you'll hear the kinds of questions that they ask and the people that they're talking to, and you'll start to get a feel for just who it is that you basically want to be in partnership with for the next 5 years or more.
Great. Is there a minimum amount that is typical for investing in syndications, or can you do small amounts, like a couple of $1,000s?
So if you want to do a couple $1,000s, it's best to. That's not going to typically work for most syndicators. It's just not worth it because of all the paperwork and stuff. Yeah. So a minimum. I mean, syndicators will have different minimums. Sometimes the minimum is 25. Sometimes it's 50. And sometimes if someone's getting started, or you have a personal relationship with someone, they may let you in the deal for less. So it's kind of on a case-by-case basis, how much the minimum is. And also keep in mind that not all deals are available to everybody. Some deals are available just to accredited investors. An accredited investor means that you have either a net worth of $1 million between you and your spouse outside of your primary residence, and or your incomes exceed $300,000 if you're married and $200,000 if you're single, and for the last 2 years, with the expectation of that same thing going forward. So some deals are open to both sophisticated investors and accredited investors. There's some nuances there. It has to do with the SEC regulations or exemptions under which we're operating. But yeah, so that's just another aspect of like what's required for certain deals.
If you fall under those circumstances that you said for accredited investor, do you have to go through like a special, like what do you have to do to show that you have that to become accredited?
So there's a couple different ways to show accreditation. You are oftentimes asked, we oftentimes have to get third-party verification. So one of the ways to do that is you can ask your attorney or CPA to fill out a form and sign it. And some will be willing to do that. And some may charge a fee depending on how simple or complicated it is. And some may just do it if they, it's really easy. If they know what your income is, it can be really easy. Some firms, like some CPA firms, just don't do it as a matter of policy. And then there's other services that you can use, we use verifyinvestor.com. And basically you just upload whatever documentation you need, and it costs like $60 or something. You upload whatever documentation you need. So if you're going to be qualifying via income requirement, you'd need to upload like some of your tax documentation. And if you were qualifying on net worth, then you would need to, they have various kinds of documentation that are required for you to prove that you own, the properties that you own or whatnot, and what their value is. But it's like, it's definitely doable. It's not too much paperwork all in all. So yeah.
All right, thanks.
Yeah, for sure. So what else comes to mind? Anything? Oh yeah. So one thing I wanted to touch on was, the difference between investing in stocks and investing in real estate. And I think investing through syndications. And I think the main thing with when you're investing in stocks is that to some extent, you're basically you're throwing a dart in the darkness a little bit. It's like you don't really know what's going to happen with that stock. It's kind of a gamble. And in my opinion, I have some money in stocks, but I don't actually manage, I have someone invest for me because I don't really want to throw a dart in the darkness, and at least the person who's investing for me is looking at things a little bit more closely than me. But it's still a bit of a gamble because there's more volatility in the stock market. And with real estate, if you have a really good sponsor who's being conservative, then the property is more likely to be able to be to have the business plan executed. The sponsor is more likely to execute the business plan and not have to stray too much from it if they're really good at what they do. So, and you're looking at financials, you're looking at projections. It's not just based on an idea of what direction the stock's going to go, if the stock's going to go up or not, or et cetera. Like it's actually based on, we're looking at the market. We expect rent to grow this much. We're taking conservative assumptions on this, and this. And, we're conservatively making a projection, and you want to try to make sure your syndicator is being conservative. So I would say that's one of the main differences between stocks and investing in direct real estate is that it's more predictable because there's a bit more of a formula that you can look at. Does that make sense? Yeah. Do you have that feeling when you invest in stocks, or what has your experience been with investing in the stock market?
Yeah, I tend to, I don't know what I'm doing. I just kind of guess. It is like a guessing game, but I do invest in stocks or in companies that I know or feel like I am a customer of or consumer of. So I like to go where it's a little bit more known versus kind of investing in just throwing a dart in the dark, like you said, things that I don't know very well, I'm much more hesitant to invest in.
Mm-hmm. For sure. Yeah. Well, I mean, so I think that we've covered a fair amount of ground. What are your thoughts on syndication investing overall? Does it sound appealing to you at this point? I mean, I just frankly, like, is it something that still makes you nervous? Where are you at?
Yeah, I mean, I think it definitely sounds appealing. I feel like I need to do a little bit more research, but I'm really interested in kind of starting to network and understand it a little bit more and get started.
Yeah, totally. Well, that's been awesome. It's been so fun to have this conversation with you, Brittany. Thank you so much for coming on. And, we'll have to have you on again when you're a little bit further down the line.
Yeah, thanks for having me.
Awesome. Well, we'll see you next time. Bye.
Bye.